Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It's, of course, another Monday back at work. October the 20th, of course, this starts the first of the two biggest weeks for earnings this week. Netflix, a couple other big mega companies out this week. Next week will be Apple, Microsoft, all those guys. So again, over the next 2 weeks, lots of earnings reports. This is going to be, by the time we get to next Friday, not this Friday, but next Friday, we'll have about 80% of the S&P 500 will have reported. But so far, so good. But we have about an 85% beat rate, not surprising as we came into earnings seasons we talked about before. A bit on the low side in terms of expectations. We cut expectations pretty dramatically, particularly back around April during Liberation Day. We took big cuts to earnings, and even though those earnings estimates rebounded after Liberation Day, they never got back to where they were previously. So coming into this earnings season, a bit under expectations, as I should say, lower expectations. So again, this is resulting in a fairly high beat rate. Again, it's early right now. We've had the major banks, we've had the regional banks report, but so far, again, early, have about an 85% beat rate. So it's pretty elevated relative to history. So, but again, this next 2 weeks will be really important. On the 24th, we will get the CPI report will be released, and that'll be 2 days before the next Fed meeting. So we'll get the CPI report. We'll have a look at inflation, which we haven't had as of late. A look at it. I'm not saying we didn't have inflation. We haven't had a look at the inflation report, but we'll have that 2 days before the Fed meeting on the 27th, where the Fed's expected to cut rates by 25 basis points. So again, pretty busy couple of weeks coming up. We'll have a lot to talk about. But outside that, other economic data remains. We saw the Philly Fed regional index last week that came in at negative 12. So we're still seeing some weakness in the manufacturing area. Services continue to do okay. However, saying that, some of the off-the-books surveys of retail spending, like Bank of America credit card reports and others, are certainly showing some weakness in spending by the consumer. So we'll see here when we get kind of caught up. We reopen the government, which may not be till around Thanksgiving at this point. So again, we're starting to get fairly long into this shutdown so far. But when we eventually get the shutdown resolved, which we will, we'll get a lot of this retail sales data, et cetera. But again, some of the kind of off the books metrics of retail spending certainly showing a bit of weakness here. So again, we continue to see this kind of bifurcation between the markets, which is exceptionally bullish. Outlooks are really strong for earnings growth and expectations for future earnings. But the economic data continues to come in a bit weaker than expected. So again, at some point, and again, I've got an article coming out about this about next Friday, discussing this idea about economic resurgence. So even though we're having this current bout of economic weakness, it's largely expected that we're going to have this reversal of economic weakness back in economic strength as we move into next year. We'll see what happens. But this kind of goes to the juxta of today's commentary that we'll get into in just a moment, which is it's okay to think like a bear, but right now this market remains very bullish on a lot of different fronts. But speaking of bullish, here's what you need to know before the bell this morning. So so 2 Fridays ago, so last Friday, not this past Friday, Friday before last, we had this fairly significant market crack. That market was down about 2.7% for the day, touched the 50-day moving average. We spent all last week just trading between the 20 and the 50-day, just stuck in this very tight range between these moving averages. The 20-day, which has been running support for the market, has now turned into resistance here as of Friday. Again, but support right below that at the 50-day moving averages. These continue to run very close to each other. This morning, futures are pointing higher. So we're expecting this market to try to break above the 20-day moving average today. Now, again, as we talked about last week, the fact that we finished the week below the 20-day moving average, and again, this is how we've talked about, be careful with your stop losses sometimes. A lot of times people will set a stop loss at a moving average and they go, well, as soon as I break below that, I'm going to sell everything. So they get out of the markets, and then the market immediately bounces back above it and then continues to move higher. And so a lot of people get frustrated with trying to, hold stop losses in portfolios because they get tripped out of them. Well, this is why we want to give it a few days. Sometimes when you break these moving averages, give them a day or two to see if they can get back above that or not. And we failed to really we did get above it temporarily, fell back below it by Friday. So again, that 20-day moving average is now acting as some decent resistance. So again, just because the markets are pointing up this morning, Dow futures are up about 43 points, the S&P's up about 9-10 points this morning. So it's not a really strong open, but we do need to see some follow through this morning. We need to open up, get above the 20-day moving average, and stay above it this week. Otherwise, that's going to continue to build resistance pressure for the markets, and that's going to start to threaten this 50-day moving average a bit more. And again, while this 50-day moving average is holding support right now, there's a lot of stop losses that are set right at the 50-day moving average on kind of a professional computerized trading algorithm basis. So if we take out the 50, we could see some fairly sharp selling. So watch that very closely here, because that's going to be your key support this week. We need to hold above that this week. And then the market needs to get back above this 20-day moving average if we're going to start to try to move forward and start to rally towards a year end. Now, again, there's a lot of reports out this week. So this week will be pretty much just dominated by earnings. So if companies come out, if Netflix and others come out this week with really good earnings, good positive outlook, etc., I would expect that we'll climb back above this 20-day moving average. So again, there's going to be some good support this week from earnings. Next week, again, even more support potentially, depending on what Amazon and Apple and Microsoft say next week in terms of their earnings. There's going to be a lot of potential buying here. So again, just be a little bit cautious being overly bearish here, because the markets are still in a very bullish trend. We're still holding the 50-day moving average. The trend is positive. We did get kind of oversold on a relative strength basis, kind of rallying back now. So we're starting to see a little bit of relative strength come back, but we're still on that momentum sell signal still at an elevated level. So again, there are some reasons to be a little bit cautious here, but overall the market remains bullish, and we're moving into the two seasonally strong months of the year, November and December. So as we get through earnings season, buybacks come back, we should have a good earnings season. That'll help support markets. But again, just be a little bit cautious with your risk management and just navigate it, and you'll be fine. But markets should end higher this year than where they are currently, at least at this juncture. That's what you need to know before the bell this morning. When we come back, we're going to talk about a little couple of different things. Kind of this speculative investing that we're having in a zero risk environment, but also, why it's important to think like a bear but invest like a bull. So that's all coming back this morning right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome to the show this morning. All right, so it's going to be a little bit of class this morning here on the show, a little bit of investing class. I've got two things I wanted to really kind of talk about. One is, and both of these conversations, they're tied to articles that I've posted over the last couple of days. I've been kind of on this risk management roll over the last couple of weeks, past few days as I was writing last week. And just kind of looking at the market and the speculative environment that we've got going on right now. It's certainly kind of an interesting environment that we're in. In fact, I just posted a chart this morning on Twitter or X. Someday I'll get used to calling it what it is, but it's X. But what we've continued to see And again, it's running at a very high rate right now, which is this idea that markets don't have any risk. It's just every dip, just buy every dip. It's fine. You're going to do well. Just whenever markets pull back, that's your opportunity to buy some more. Don't worry about downside risk. And this is what's been, training investors now really for about the last 15 years, which again, because of zero interest rates and quantitative easing and bailouts of this, that, and the other thing, and checks to households, et cetera, we continue to see this advance in the markets, and we've created this, and we talked about moral hazard last week, which is this idea that, I've always got insurance, so just buy the dip, so there's no risk. And so this chart this morning was interesting because it shows the returns by just what happens on a down day. So like last Friday, or Friday before last, we had this 2.71% decline in the markets, and markets are higher since then. Now, it's not been a straight return back to all-time highs yet, but they are higher than they were off that dip. So every time the market has dipped, you've been rewarded just by buying the sell-off. And in fact, this is the largest return year right now for buying the dip in the last 30 years. So you've been well rewarded this year just to buy if you just buy the down days, you've been rewarded for it for the most in 30 years. And this is what is kind of this idea that's going on with the markets. And again, you can bring up this chart for me. I can't expand it for some reason. But we're in this period of low volatility. And when you're in periods of low volatility, markets perform well. And that's because when there's no volatility, markets are just going up. You're just buying every dip. But what's important to remember, though, is that periods of low volatility are always followed by periods of high volatility when markets don't work well. So it's easy to get complacent in a low volatility environment. And this is that zero risk environment. Thank you, Brent. This is that zero risk environment that we're currently living in right now. And this illusion of safety. And again, we were talking about, zero risk and this idea that the Fed's always going to bail me out has certainly, go ahead, and has certainly been, evidenced by what's been going on. So what this chart shows you is the Fed funds rate, that's the red line, and balance sheet contraction or expansion versus the S&P 500. And so and it's not surprising, when the Federal Reserve is shrinking its balance sheet, doesn't mean markets just go down, but markets have a bit more trouble. And they have, they do kind of experience periods of drawdown, et cetera. And that was pretty evident in previous cycles. However, since 2020, really since the October lows of 2022, despite the Fed contracting the balance sheet, although that balance sheet contraction has slowed, rather dramatically, the markets have been accelerating. And this has really been that evolution that occurred following the 2022 sell-off that, Fed's got my back and I'm just going to buy everything. And it doesn't matter what the asset class is, I'm going to buy it and it's going to go up in price. And again, investors have been well rewarded for doing that. Now the Fed's talking about, obviously, getting rid of QT. So we're now talking about stopping QT. So that's going to shrink that's going to stop that balance sheet reduction. So we're going to move back to basically a flatline scenario that's supportive for stocks. Also, the Fed's now cutting rates, and we expect a couple more Fed rate cuts here shortly into year end. So whenever the Fed's been cutting rates, that's also been supportive for stocks as well. So again, just a lower interest rate environment's been supportive for stocks. So we'll see how this works out. But the historical correlations have been broken somewhat in the last 3 years in particular, as this speculative surge in the market has really just accelerated to a large pace. But this is the illusion of control, right? So this is the whole definition of moral hazard. And I have this perceived idea of zero risk. And what moral hazard is simply, as we talked about previously, the definition of moral hazard is simply that I can take risk because I have insurance. And so again, think about, what does that mean? That means like I can drive my car as fast as possible, and I have been insured that I will never have an accident, right? So, my auto driving feature of my Tesla, I don't actually own a Tesla, but if I did, my auto driving feature of my Tesla car says it can drive the car as fast as possible, and it has 100% capability of avoiding all accidents. So I have no risk in the car, in theory, right? So I can just get in the car and say, drive me as fast as possible to my destination because the car assures me that I have absolutely no risk of loss. That's what's gone on in the markets. Is that what we've trained investors to do is there's a zero risk of loss in the markets. What this is a chart of, this is what's called a zombie company. This is the number of companies in the Russell 2000 index the Russell, I said 2000, Russell 3000 index that are considered zombies. These are companies where profits are less than the interest paid on the debts for the last 3 years. In other words, these companies are surviving on debt to stay alive because they don't have enough revenue or enough profitability. So debt is a function of this. That is now at the highest level we've seen since the dot-com crisis. Now, I'm not saying this is a repeat of dot-com, but what this does show you is that if I'm investing in companies, which is a lot of what's going on right now, investors are chasing these companies, and they're chasing companies that have little or no revenue, or they're called a zombie, which is they basically their debt service is exceeding their profitability. Now, if I came to you as just an individual, I just came over to your house and I said, hey, I got this great idea for this. You need to invest in my company. My company is my debt is huge, and I'm just, my interest is eating up every bit of my profitability. But if you'll invest in my company, someday I'll turn profitable. And because I've got this really cool idea. And you go, great, here's my money. I mean, would you do that? Right? You wouldn't do that if somebody explained it to you what was going on. You would say, I'm not investing in that company. That's ridiculous. They're going to go bankrupt. But in the markets, we don't care about that because simply the price is going up. And the Federal Reserve has assured me that even if things fall apart, they're going to step in and bail everything out. So why worry about it? Right? This is the zero risk environment we've created. We see this in credit as well. So what this chart is this is the chart of junk bonds to A-rated securities. Now, normally when you hear about these types of bonds, they're called high yield. I have my quote fingers up, even though we have a chart. High yield is simply a Wall Street marketing term to sell you junk-rated debt. It's high yield sounds. If I came to you again, I come to your house, I say, hey, I've got this great idea. I've got a company that's on the verge of bankruptcy. Would you like to buy my debt? You would say no. I mean, the obvious answer would be no, I'm not buying the debt of your company. You're about to go bankrupt. But that's what we're doing in the markets. And likewise, when you think about high yield debt, right? Somebody comes to you and says, hey, I've got this great junk bond. I want to offer you the junk debt of my company. You go, okay, I'm good with that, right? I understand junk bonds. And I understand that I'm running a risk of potential default, but I'm going to loan you money for 6 months. I think you can stay in business for 6 months. I've looked at your financials. I think you stay in business for 6 months. Now, if you're going to do that, though, what would you expect in terms of an interest payment, right? Right? That yield should be somewhat higher. I would say dramatically higher than what I would be willing to buy the bonds for from an A-rated company, right? An Apple bond as an example, right? Apple has no risk of default. So if there's no risk of default, I'm not taking any risk in terms of the credit, then I should get paid something close to treasuries. If the treasury rate is 4% and I'm investing in a corporate bond that has no risk of default, say like an Apple, I should probably get close to a treasury rate. That just makes complete sense. But if I'm investing in a company that's about to go bankrupt or has a high likelihood of bankruptcy in the next 6 months to a year, or whatever the duration of the credit is that I'm buying, I should be paid enough to justify taking on the additional risk. So instead of a 4% treasury yield, I should probably be getting 8 or 9% on a junk bond, maybe even 10. So I can at least collect some interest. So if the debt does go bankrupt and I've got to go sue the company to try to get paid, off whatever assets they have, I've at least gotten enough of my money back, maybe through the interest payments of 10%, that I'm not out that much money. Right? That would be the logical conclusion, but that's not what's happening right now. Go back to that chart for me real quick. What this chart shows you is that right now the spread, the differential between buying a junk bond and buying an A-rated corporate bond like an Apple bond is virtually non-existent. It's about a 1% spread. It's the lowest level we've seen since 1998. If you don't remember what happened in 1998, after 1998, I don't know what I need to tell you. But investors are not being paid to take credit risk. Why? Because the government said there's no risk. They're going to bail it out. We bailed out junk bonds in 2020 when the pandemic hit. So we taught investors, hey, why worry about credit risk when the Fed's going to bail you out? But this is all symptomatic of this world where we live in now, where we just have an exuberance about investing capital in markets. And this is very typical of the investment psychology cycle, which when you're in markets and you start having this, kind of euphoria to just, put money into every asset class, no matter what it is, and we come up with rationalizations why this asset class is going up, whatever reason it is. That's the euphoria stage. We are well past exuberance at this point in the markets because we're just simply buying every asset and we're buying every dip. There's never a concern about the markets. But this is that cycle, that investor psychology cycle that continues to exist within markets, and it never changes. Now, these cycles can last a while, mind you, and particularly they can last a while, and I'm talking about years. These can last 3, 5, 7 years. They can last a fairly long time, so you need to be aware of that. But when you're in these cycles where we start rationalizing why there's no risk in an asset, regardless of what the price is doing, that's where you've reached that euphoria stage of the markets. And there's lots of evidence of that right now across asset classes. But again, this is the issue that we come back to kind of repeatedly throughout history. And again, one of the things that's doing a lot of the heavy lifting right now and certainly helping that, and one thing that investors are counting on, is that we have this other buyer in the markets. It's not just retail investors. It's not just institutions. We have corporate buyers in the markets. And show this chart, Brent. So this is the announced share repurchases. So this is corporate buybacks. The light blue line in the middle is, the dotted line in the middle is the average, 3-year average of corporate buybacks. And you can see that this year, which is the dark blue line, is running well far above the 3-year average for buybacks. And that's one of the reasons why the market's been so strong, is that as these buyback windows open, there is a lot of buying coming into the markets by this other buyer. In fact, corporate buybacks since 2000, corporate share buybacks have accounted for nearly 100% of the net equity purchases in the markets. So again, a lot of support. And as we move into the end of this year, November and December, we're going to have about $7 billion a day in buybacks coming into the market. So that's just a lot of buying out there. Again, that just feeds into this idea of this zero risk environment. Again, I have no risk because everything just goes up. And I may not really understand why things are just going up. I just know that they're going up every day. And I know that every time I throw money into the markets that I make more money. And that's certainly a good thing. I mean, we certainly like that a lot, right? That markets just go up and just never go down again. But things will change. And the problem with being in a zero risk environment is when they do change, that typically catches investors offside. But this is part of where investors make a lot of mistakes. As we were looking at that investor greed cycle a second ago, This is where investors make a lot of mistakes. The market, and we talked about this a little bit last week. The markets are not going to, there's a lot of people worrying about the next big bear market, right? I get lots of emails like, hey, this market's going to crash. Aren't you worried about it? It's like, yeah, of course, I worry about it all the time. And that's going to be our next conversation here about thinking like a bear. Yeah, I worry about it, but it's not going to happen tomorrow morning. I'm not going to wake up tomorrow morning and the market's going to be down 50%. I don't need to worry about a 50% decline tomorrow. I need to worry about a 3% decline tomorrow, where I wake up and all of a sudden the market is broken for some reason and the markets are down 3%. Oh, like 2 Fridays ago. Now, immediately everybody goes, yeah, but 2 Fridays ago the market breaks 3% and it went right back up. Correct. It did. So I don't worry about that break. I know when I wake up one morning and the market's down 3%, now I need to pay attention. Now the market's telling me something, but I don't know what it is yet, but it's telling me something. So if I wake up and the market's down 3%, I certainly need to be focused on what's happening. Why is this happening? What's causing it? But I need to figure out, and I'm going to have to wait till the next day, is what's the market going to do about it? So tomorrow morning I wake up and the market's down another 2% or another 3%. Now I need to start worrying. Now I need to take some action in my portfolio because the market is now confirming that whatever is going on is a bigger deal. This is why, like during the Liberation Day sell-off, the market was down like 10% in like 3 or 4 days. That's the type of thing that you need to worry about, is when that happens. You're not going to wake up and the market's down 50% in one day. You're not going to lose all your wealth in one day. But over the span of a couple of days, you can figure out fairly quickly, and technical analysis will tell you that, if you're breaking levels of support, if the psychology of the market has changed, if whatever event has occurred is a bigger deal than just a one-day sell-off. So again, the one-day sell-offs you don't worry about too much, but if there's 2 in a row, now you start paying attention and start taking some action. But again, if you can frame these 5 steps for me. Thank you. So this is kind of how to navigate that risk in your in this current risk, this zero risk environment. Is kind of reframe risk as a constant, not a variable. Too many times we just look at, we're looking at one event and we just say, okay, that's, it's tariffs, right? That event. And so we stop paying attention to risk because we start treating it as just a variable and that it just goes away. And when we take a look at the VIX index right now, there seems to be no risk. But reframe that way you think about risk as a constant, and that and again, this is going to be more of our conversation here in a second, but when you reframe risk as a constant, it now helps you start to put a framework around the investing in your portfolio, and understanding that when you have very sharp moves higher in an asset class, it will eventually mean revert. It's a function of time. May not be today, may not be tomorrow, may not be next week, but something will eventually occur that is going to cause that massive deviation from its extreme, from its normal means. That extreme deviation is going to reverse at some point. So eventually, at some point, the markets are going to retest their 200-day moving average, and that's going to be an unpleasant event. It's going to be a 10 to 15% correction, and people aren't going to like it. But that's going to happen at some point. That's the risk. So just understanding that risk as a constant, this is when we talk about managing risk, rebalancing, doing those type of things, and just taking small little corrective actions in your portfolio can help you reframe that risk. Diversify the source of return, not the label, right? Don't worry about what the label is in terms of, I own this asset because everybody says this asset is going to be the best performing asset. Don't worry about that. Diversify by source of return. Own assets that respond differently to inflation, liquidity, policy shocks. Real diversification is more of a behavioral, not a cosmetic type thing. And again, if you've just been investing in a diversified portfolio of emerging markets and small caps and mid caps and large caps over the last 15 years, you've vastly underperformed the index. You might as well just been invested in the S&P 500 because diversification hasn't really worked. So pay attention to returns. What's creating returns, and diversify in that manner. Cash remains key. Holding cash. One of the things that investors make the biggest mistake on is they have some cash in their portfolio and they go, my cash is just not earning anything. I've got to get it put to work today because I'm losing money to inflation. You're not losing money to inflation today. Inflation, you lose money to over long periods, years. Having cash in your portfolio today is not hurting you. It gives you optionality. So when you have these corrections in the markets, you have cash to buy the dips. If you have cash in your portfolio and you experience a bigger market drawdown, it acts as a hedge. It gives you options. One thing we're going to have to deal with is recognizing that the Fed's not omnipotent. And eventually, policy changes may not have the impact on the markets that everybody expects them to have. And then most importantly, measure your success by time horizon. Forget about headlines and forget about what the market did yesterday or this week or this month or even this year. What the market does this year is irrelevant to your long-term financial goals. Build your portfolio to generate the returns you need to meet your goals over time and protect you against drawdown risk. Because markets don't punish greed, they punish complacency. And that's what we're seeing the most of right now is just a lot of complacency in the overall market. So again, this is why this idea of investing in a zero risk environment is so dangerous, because it breeds complacency. And we have a lot of complacency in the overall markets right now. Take a look at this chart right here, which is this is U.S. tech valuations in the markets. And we're currently at valuation levels higher today than we were in 2000 in tech. Now, immediately that doesn't mean the market's going to blow up. This is my whole point about complacency. Right? Complacency is breeding high valuations. We're willing to overpay for stocks today on the expectation that future earnings are going to make up for that overvaluation. Now, we all know inherently that's not true. But that's how we rationalize overpaying for an asset. When assets are going up and they're beyond their fundamental valuations, we come up with rationalizations why these big deviations from long-term means are sustainable. We know they're not inherently. We know we're lying to ourselves, but we do it anyway. But here's another good example of this, what's going on in the markets right now. This is low volatility stocks in red. White are good balance sheet stocks. The light blue is bad balance sheet stocks. And the gray line at the very top is high volatility stocks. What's having the biggest returns this year? The things that have the worst fundamentals. Complacency. Moral hazard, right? Again, we talked about just a moment ago about being bailed out. Now, this is why it's important to think like a bear. And so this is kind of the premise of the show today. Think like a bear, but invest like a bull. Right now, I've got to invest like a bull. Why? Because markets are going up. The seasonality, the earnings flows, the retail buying, the corporate buying, all that is very bullish for the markets. But yet, I inherently know that I'm buying bad assets. And I'm willing to do it because they're going up in price. I'm willing to overpay for valuations today because, why? There's no risk of that. And that's certainly a function of reality. And this is just consumer sentiment. This is just investor sentiment in general. So what this chart shows you is this is consumer confidence and higher stock prices in the next 12 months versus valuations. And you'll notice there's a very high correlation. And you would expect that. When I'm very confident about returns in the next 12 months being higher, then I'm going to overpay for assets today. I don't have a risk. And that's what's going on. So valuation, and we talk a lot about valuations, but what that chart really tells you is that valuations in the short term over the course of a year or even two is simply just a function of investor sentiment. I'm willing to overpay for stocks, so valuations go up. So that's all it tells you. Now, what valuations tell you on a 10-year basis, on a longer-term basis, is what your returns are going to be. So where valuations are and where investor sentiment is today, this idea of zero risk environment, that tells you that forward returns are going to be lower because eventually that zero risk environment becomes a 100% risk environment. Don't know what causes it, and I don't know when it will occur, whether it's next year, the year after that, but at some point, the realization of risk will come back into the markets across all asset classes. Doesn't matter what asset class you're in today, at some point it's going to experience a 30 to 50% decline. Doesn't matter what the asset class it is, it will. And the question is, how are you going to navigate that? And this is just kind of the function. So what this chart shows you is kind of where we are in this environment right now. This is the kind of the cycle of, kind of technology innovation, AI development. We're right there on the mass media hype side. And the supplier proliferation, right? So we've got this artificial kind of circle of money between companies right now, OpenAI into Oracle into NVIDIA, blah blah blah. Everybody's just investing in everybody else right now. So you just got this supplier proliferation and investing funding going on. You've got this mass media hype around AI, what it's all going to be, and you just and then you've got this activity going on with all the early adopters. So, you've got all the evidence of kind of this peak AI cycle that's going on. Now, that again, this takes time. This doesn't mean like tomorrow morning everything's going to come undone. That's not what this says. It just says that we are very late in that stage of the investing hype within the markets. Okay, Brent. And then eventually that's going to change. And when that changes, this is when these earnings expectations that we have, reality doesn't meet those. And then we have to start readjusting and reassessing the things that we are doing within our portfolios. And this is why thinking like a bear can be advantageous to you. Now, it doesn't mean be bearish. It just says think like a bear. I want to be bullish. I want to invest like a bull when markets are going up, and markets are going up right now. So I want to be invested, but I need to be thinking the bearish side. I need to consider that within my portfolio to help me control risk. Told you it's going to be a little bit class today. Investing class 101. And this is why when you take a look at forward earnings, and forward earnings are so important, not just, when we look at forward earnings, we just look at forward earnings for the next quarter, but don't look at forward earnings for the next quarter. Look at it over time. Because even though forward earnings may be higher, I want to know what the year-over-year rate of change of that forward earnings expectations are. Because if they're declining, market returns are going to be lower. And there's a very high correlation with the annual change in forward earnings and the annual rate of change in the S&P 500. Right now, those earnings expectations, after declining, and you can see the big drop-off on the right-hand side, that big drop-off, that was second quarter, that was the April tariff kind of snafu, right? So forward earnings got cut. Now they're rebounding. But you'll notice they're not rebounding back to where they were. So the question is that if we don't have a fairly strong earnings growth and where forward earnings are getting really picked up, the market's going to have a bit more struggle of being higher in the future. And if that annual rate of change starts to decline again, that's going to be the bigger risk. So if all these expectations for earnings fail to get met, and we start having to reduce these forward earnings expectations, and that year-over-year rate of change in expectations begin to decline, that's going to weigh heavily on markets because markets are going to have to readjust for valuation expectations. And so this is something, if I'm thinking like a bear, I want to pay attention to this. Doesn't mean I go sell all my stocks at all because I want to be bullish right now, but I want to watch these indicators that can tell me what forward earnings are going to do and then how that's going to overlay into the returns coming out of the markets. Because if markets begin to have to readjust for forward valuations, which are very high right now, then I'm going to have a bigger problem to deal with. So again, the premise that, we want to get to is, thinking like a bear, but that does not mean be bearish. There's a lot of people that think like a bear and they are bearish all the time. And they consistently underperform markets. They consistently have poor returns, but they're all hoping that someday that this thing's going to crash and then they're going to, actually make money. We're not talking about being bearish. We're talking about thinking with a bit of a bearish backdrop. Allowing, especially if you're very bullish on markets and you're very exuberant in your portfolio right now, which is fine. There's nothing wrong with it because markets are going up. But this is where you need to start asking yourself the hard questions. What happens if, and be honest with yourself. Go back to April. When markets were down 19%, how did you feel? Be honest with yourself and say, yeah, I remember that. I was pretty torn up over that decline. I was really kind of sick to my stomach. And yes, it's all come back. It's all fine now. And we say, well, see, that I just wrote it out and it's all fine. But what happens if we're down 19% and it becomes a 25% decline or a 30% decline? At what point, and everybody has a point, at what point are you just going to sell? You say, I've had enough, I'm out. Typically, that point is near the market lows when it occurs. So if you can think a little bit bearishly and be honest with yourself about how you react during downturns. And again, everybody's different. I know people that during downturns, they're buying all the way down. They're like, I know, market's going to come back someday. I'm okay with it. I'm just going to keep buying stuff. And that's their mentality. They're completely unemotional about money and markets. That's completely fine. If you're not that way, be honest with yourself. And this is why you want to establish trend break rules in your portfolio. You can bring up this list, Brent. Define when the trend is broken. Whether, if you're a short-term trader, use the 20-day, 50-day moving average. If you're a long-term investor, use the 100-day, 200-day moving average. But at some point, markets are going to break those trends. And then when those trend lines are broken and you have momentum divergences, etc., that's where you need to start reducing exposure. Now, again, if you're a long-term investor, it's like, I'm going to own these stocks and I'm going to hold them for 20 years. That's my plan. Got no need for the money. Use a 200-day moving average. It's fine. However, the problem is that to get to the 200-day moving average right now, you're going to be down 10, 12% from the peak. Can you live with that? I know you just told me you're a long-term investor. You're completely fine. But will you hold stocks down to the 200-day moving average right now if that's going to take 10 to 12% out of your portfolio? Be honest with yourself. If that answer is no, then don't use the 200-day moving average. Use the 100, use the 50, use something else. But when that trend line is broken, whatever it is, reduce exposure. Does that mean sell everything? No. It just means cut back on some risk. The other problem we do is that we jump into everything all at once. It's like, I want to buy this company and I'm going to put 5% of my portfolio in this stock, ABC, right now because it's going up. Don't do that. Scale into it. Buy 1% today. On pullbacks, buy another one. Just work your way into it over time. And that way, if something goes horribly wrong right up front, you buy it right at the peak and then it turns lower and goes down 30%. You've only got 1% exposed. So scale into your exposure. Use your stop zones. Use dynamic trailing thresholds. We use moving averages, so we have a trailing stop. So it's adjusting all the time. Tier your exposure by risk class. So if you're investing in things that have a very high, very volatility, very high betas, largely, very volatile, tier your exposure to those stocks. Have more exposure in your defense. Monitor your outside equity signals. Watch things like credit spreads, yield curves. We talked about the most important thing to watch are credit spreads. If those things start blowing out, you need to reduce risk in your portfolio because something is going wrong. As long as credit spreads are low where they are right now, there's nothing wrong with the markets. Credit is fine. Everybody talks about, the debt. No, credit spreads are telling you everything is fine. There is no risk in the credit markets right now. Will there be at some point? Absolutely, but it's not today. Transition to a defensive posture incrementally. So when you start having the market decline, that you move from stop buying first to see if the market decline is a 1 day or a 2 day event, and then the market's going to start rallying again. So you just stop buying. And then if it begins to really break down, you're taking out your stop zones, you're taking out your kind of your trend lines, those trend breaks, then you begin reducing exposure. Reduce your aggressive holdings first, then move through. And again, maintain optionality. We talked about earlier about holding cash. Cash gives you optionality. And so, what this really comes down to is just accepting uncertainty, having some probabilistic thinking. Thinking like a bear doesn't mean being bearish. It just means having some probabilistic thinking. What could happen? How is it going to impact my portfolio? And how should I respond to it? And again, be honest with yourself at the end of the day. Being unemotional is the key to long-term success. And particularly being unemotional at the extremes, that's where it becomes very problematic for investors because they allow their emotions to override. And they jump into another asset class that they see as being defensive, and then it takes off running, and then they fail to recognize that now risk is developed in that asset class as well. Happens all the time. So, just be cautious about managing risk. And it's not complicated, and it's not a issue that you can't do. It's just you have to be honest with yourself. And be honest, and what I mean being honest with yourself is not just being honest in terms of, what's going on in your portfolio, but being honest with your personality. How are you going to respond to these events? Are you going to freak out and sell everything when the markets are down 2 or 3%? Or are you completely okay with that and you can have these longer-term holding periods, use longer-term moving averages as your trending levels, et cetera. But you have to be honest with your own personality. Everybody's different. But again, that's the secret. That's what separates out retail investors in a lot of cases from professionals that have whole teams to work with, right? You're just over here by yourself trying to manage your money. So it's easy to allow emotions to infect your thinking. But maintaining a bit of a bias, and again, thinking bearishly, again, you got to be invested, and we want to invest like a bull, especially during a bull market, but having a little bit of that bearish thinking to just bring in being probabilistic about what are the probabilities of things happening, not the possibles, right? Is it possible that someday we're going to wake up and the markets are going to be down massively, and we're going to be moving into the next financial crisis? That's very possible. But it's not probable this year. It's probably not probable next year. Is it possible that at some point this whole AI bubble is going to come to an end and it's going to have a massive blow off and we'll repeat the 1999, .com crisis? That's possible. It's not probable this year. So thinking in terms of possibilities versus probabilities can help you manage risk a bit better. But remembering that possibility is there also needs to apply to how you construct your portfolio. Having some construction in your portfolio for the possibilities to protect you in the event that the possible becomes reality or that the possible becomes probable, because it can happen quickly. All right, I hope that helps. Both those articles on their websites with all the charts. Just go to the website, realinvestmentadvice.com. Be sure to like and subscribe to the channel. We appreciate it very much. We've got a really great interview coming up with you on Wednesday with Ben Grand, talking about investing for your kids. Had a really great conversation with him on Friday, so we're going to air that for you on Wednesday. You'll really enjoy it. It was much better than I thought it was going to be, honestly. Great interview. You'll really like it. We go through a lot of stuff. Of course, tomorrow, John Penn with Two Dads on Money will be here. Be sure, and again, like and subscribe to the channel. Helps me a lot. I really do appreciate it. We're very close to 100,000 subscribers on X. So jump over there if you don't follow me on X, at Lance Roberts on X. Get me to 100 grand. Appreciate that. And of course, follow me on Substack as well for all our reports as well. It's all there for you. realinvestmentadvice.com. Have a great day.